September 2008, the fourth largest investment bank in the US, Lehman Brothers, declared bankruptcy, dropping 93% in stock price in the few days before going bankrupt, then causing a 4.5% crash in the Dow Jones that same day, causing or being part of the 2008 recession. 15 years later, March 2023, SVB, or Silicon Valley Bank, has been seized or shut down by regulators. The bank had over 8,500 employees, probably zero now. The stock was worth over $700 per share just 2 years ago, probably zero now. You can't even trade it actually. It was the 16th largest bank with over $200 billion in assets, making it the second largest bank bust in history. It just all seems too familiar, right? History repeating itself. The government cutting rates so low, banks and people take on all this debt and also make a lot of money using almost free money. Then the government realizing they need to raise rates. The banks and civilians are so over leveraged they can't afford the payments, or their investments drop and they lose everything. You know what else is all too familiar? A flashback to a video I made about lying, stealing, and cheating to get rich. The CEO saw this coming, decided to bail, cashed in $3.6 million of shares just before it crashed. He'll be fine. He's already a multimillionaire, but he just needed a little bit more money. Back to the point of this video, SVB. Is this another recession trigger? I'm not an expert. I don't know why we haven't fallen into a recession or chaos yet. I've been talking about a recession for almost a year now. I kind of just want to get it started so we can work on getting it over with and onto a recession and recovery already. I'll spend this video giving you the facts, what I know, and maybe what it means for people or companies who had money with that bank. I stole this meme from someone in my Discord server, but I feel it's very appropriate for this scenario. FDIC, or Federal Deposit Insurance, was created 90 years ago during the Great Depression to restore faith in the US banking system. Any US bank has their customers' deposits insured. If you deposit at a bank, if the bank goes under, you're insured, but it's only insured up to $250,000. Obviously, there's a cap. SVB has this insurance, so some of their clients will get back $250,000. However, looking at their books and their disclosures, only 2.7% of their clients had $250K or less, meaning 97% of customers will be losing hundreds of thousands or maybe millions of dollars. In fact, we have the numbers. SVB had $151 billion of uninsured customer deposits just a few months ago at the end of 2022. The effects of this collapse doesn't hit Canadians directly, but obviously we'll feel the indirect effects since we're so tied or so reliant on the US market. Many of SVB's clients were startups, VC firms, or tech founders, not many retail clients. It was mostly other businesses. The issue is, I just heard a story from a friend where all their company's money is tied up in SVB and they weren't able to make payroll. The staff weren't able to get paid. When a company goes into receivership, it's being controlled by the FDIC right now. There's a small chance vendors or creditors can get back more than the $250,000 insured, but there's no guarantee you'll get anything significant. Looking at the blurb FDIC on FDIC's website, specifically about Silicon Valley Bank, all insured depositors will have full access to their insured deposits no later than Monday morning, March 13, 2013. The FDIC will pay uninsured depositors an advance dividend within the next week. Uninsured depositors will receive a receivership certificate for the remaining amount of their uninsured funds. As the FDIC sells the assets of Silicon Valley Bank, future dividend payments may be made to uninsured depositors. It sounds promising, but I would have felt more comfortable, obviously, if I had scrambled and transferred all my funds to a bigger bank. Probably something I should have said at the top. This isn't the fault of fraud or lying or stealing, which I complain about a lot on this channel. It's the result of poor planning, lack of competency, and just bad timing. SVB was doing what banks do. They use their customers' deposits as loans to earn interest or invest in treasuries to earn interest. One mistake was SVB purchased $91 billion in US treasuries. They are deemed extremely safe. I think they did the right thing. The issue is the US government raised rates drastically, reducing the value of the treasuries. SVB bought 10-year treasuries worth $90 billion. Let's say they earn 2%. Within 1 year, the US raised rates so much that new 10-year treasuries would be earning, let's say, 6%. Those treasuries you bought paying 2% suddenly lost value. Why would someone pay me $90 billion for 2% returns when they can go to the market and earn 6% returns? The only way I would buy 2% treasuries is if I paid $70 billion for $90 billion worth. I paid a discount, so I end up in the same situation, the same profit. Since SVB is public, they have to report this. Everyone starts to see massive unrealized losses on their statements. They see a large decrease in asset value, so two things happen. Short sellers start selling the stock, causing the price to collapse. We get it, we've heard of this before. But also customers with money in the bank get scared and start frantically trying to pull all their money out from the bank, which obviously the bank doesn't have. Banks operate on the assumption that everyone won't pull all their cash out at once. I believe every bank will fail if we do this. If we decided to play a prank on TD like National Pull Your Cash Out of TD Bank Day, we can tank it. Everyone started pulling their money out of SVB. They had to sell all of their investments at a huge loss. They ended up with less cash on hand than the cash they owed their clients, causing them to go under. I think this would lead to current startups or VCs to diversify their banks. I know this is rare and probably shouldn't happen ever again. I believe Roku had $500 million in cash at SVB. They probably just lost 30% of their cash. In the future, maybe they can diversify to avoid the scenario if they can survive this situation. So what do we do as investors, whether experienced or new to the market? Like, I'm filming this on the weekend. The FDIC just took control of the bank. I'm not sure what will happen on Monday, but the US government has to come out and make some sort of announcement or release some news on how they'll fix this. They can't let every bank go under because this was just the beginning. The outliers will go first, and slowly everyone else might get squeezed. We might see this continually happen with the smaller banks. If the government doesn't do anything, other banks will fall, and it'll cause a huge ripple effect in North America, maybe even the whole world. In my informed or uninformed opinion, this will pass. It's not the end of the market. We could look back at US bank stocks in the future and see this as a buying opportunity. If we learned what happened in 2008, if the banks mess up, they'll just get bailed out. If you're wondering how to buy US bank stocks, you could just do an ETF. You can choose XLF. This is a bundle of bank companies all put into one ETF or one stock. It's obviously trading down. It's down over 10% in a week. It could be a buy opportunity if you're a buy and hold investor. With any investment, I recommend buying and holding for the long term. But if you're an options trader like myself, you could use these red days to sell cash secured puts. If it drops another 10%, maybe you'll own the ETF at a discount, and then you could run the wheel by turning around and selling covered calls against it. That's it for this video. I didn't release one last week. It was one of the rare weeks where I skipped. I didn't have anything important to say or to show you, so I thought it would be best to avoid flooding your notification bell, giving you a break for a week. Thanks for watching. Let me know if you have any questions and tune into the next one.